Well, despite the growing belief also by many that no deal will be struck when the clock strikes midnight on December 31st around the fiscal cliff, Jim Paulsen remains unafraid. He's keeping his 1,500 target on the S&P 500. He is the chief investment strategist at Wells Capital Management, and he joins us now from a disclosed location. And this is a curse-free interview, Jim. I just want to point that out. Why do you remain so optimistic on equities?
Gosh, all I can think of is curse words now. You got me focused on it, Brian. That's dangerous. I think the biggest thing when I look into next year here is people think we're going to grow around 2%. I think we're going to grow closer to 3%. And that difference, to me, could be a huge catalyst for risk assets in general, particularly stocks next year. I know people are, I think, overly focused, Brian, on fiscal contractionary force. I bet the most likely outcome is we get a little bit of fiscal tightening. It's more a fiscal molehill next year than a fiscal cliff. But offsetting that is an economy which is firing on many more cylinders than it was a year ago. The unemployment rate's coming down, bank lending's rising, housing activity's going up, home prices are rising, debt burdens are down, confidence is up. That's going to help growth in the coming year. In addition, there's a lot of stimulus. We've got the money supply growing rapidly. We've got record low mortgage rates. We've got the dollar down. We've got gas prices falling at the pump for the holiday season. We've got inflation decelerating from where it was, helping real incomes. I'm seeing a lot of evidence of China showing signs of reacceleration. We might get the emerging world doing better next year. We've certainly calmed down concerns about the Eurozone. So I think there's a real case that we grow 3%, the emerging world picks up, and the valuation on equities rises.
Even if we don't get a deal and taxes go up, we hear that the average family will pay $1,200 more in taxes over the year, that it's going to doom the economy. It's instant recession.
Well, there's no doubt if we have complete meltdown and gridlock in Washington and we have a $600 billion plus contraction hitting the economy next year, we probably have recession. But I think the possibility of that is so remote. I think what's much more likely is we have a mild agreement on a mild tax hike and a mild spending cut, and we extend most of what's there already to live and fight for another day. I think, Brian, this is the first of many fiscal cliffs to come, if you will, much like debt ceilings in the 1980s. And if you're going to, I think most investors have already done what they needed to do for the fiscal cliff. It's called diversification. And beyond that, I think they should focus more on what's going to be left after the cliff is.
Where can you hide? Where can you diversify away from the fiscal cliff? Muni bonds? That's boring.
Well, I think you're sufficiently diversified. Everyone should own a little bit of everything, stocks and bonds and commodities and overseas markets as well as domestic and real estate, and that's good enough. But I think if you do much more than that in anticipation of this, I think you're going to do yourself a disservice. I think it's better to focus on what we're going to return to very quickly after the end of this month or maybe a couple weeks into January, and that's the fundamentals on the ground. And they, to me, are looking better and better.
How about this, Jim? You're a rich, successful guy. You're probably the mayor of Minneapolis de facto, right? You got gold bars staffed in your garage out back, I'm sure. How are you preparing for this? How are you as an individual, not as a Wells Capital strategist, you as Jim Paulsen, preparing for the fiscal cliff?
As I said, I haven't really done any more than I've always have, and that is I'm diversified. I haven't done anything special beyond that for this fiscal cliff. I just don't really see the need to do that. I think there's just a high probability that we'll have a mild fiscal tightening as a result of this, and we're going to keep negotiating on most of the fiscal issues that we face, Brian. And I think people are going to do a disservice. They're going to take capital gains now and probably end up paying higher taxes as a result over the whole next 5 years. They ought to maintain the investment focus on what could happen over the next couple of years, not in the next 30 days.
Jim Paulsen, thanks for the bleeping great interview, man. I really appreciate it. We'll see you soon, Jim.